James, thanks for joining us. June, first down month this year. How then did the Harmoney portfolios fare?
Well, as you'd expect in a month where markets were thrown around a fair amount, we got some pretty choppy returns out of global equity markets, for example, but finishing down by about 2.5%. The Harmoney funds were not immune to that, of course, and we saw some negative returns from the whole range, unfortunately, over the period of June. But generally, I think the diversification in asset allocation, as far as it can, serve to protect capital. It was a difficult month for the preservation of capital, which we'll come on to look at, no doubt, simply because in a market where QE tapering, which is withdrawal of liquidity, is the sort of key theme, very few asset classes will do particularly well in that circumstance. But anyway, we'll speak about that in a bit more depth later. Over a longer time period, 3 months, certainly 12 months, which is a more sort of reasonable time to assess returns of funds, really, I suppose. The whole range is still very much in positive territory. A decent spread of returns, though, coming from both regional equity market differences and also currency differentials having a big effect at the moment. The poorest returning fund in the range over 12 months is up about 5%, but the strongest is up nearly 20%. So there's a significant differential in the markets today.
Okay. Taper tantrum. Can you give us a bit more on that?
Yeah, well, I think June really was a function of the markets perhaps overreacting, I'd like to think, to the Fed raising the possibility of the end of QE, in the sense that in the short term at least, it would stop reinvesting the money they're earning out of it as a coupon payment. We think that it's inevitable that QE will be reduced at some point, but the tapering that is being referred to really is just the beginning of the end rather than the end of QE. So we feel that maybe the markets are overreacting a little bit to it in the short term. Having said that, of course, we have been saying for a while that the markets are due a bit of a pause, so it's not unexpected to us. The tapering had two main effects, or two sort of main thrusts in the market, but they're both very much the symptom of the same real concern, which was if liquidity does start to reduce, i.e. the amount of money that the US Treasury is throwing into the market on a monthly basis, if that does start to reduce, what does that mean for asset classes? And the logical conclusion of that is some of the recent gains in markets, or perhaps a decent amount of some of the gains in markets recently, has come on the back of this liquidity coming in from central banks, and the withdrawal of that clearly could start reducing the frothiness in markets. This meant that both the equity market lost value, but also your traditional safe havens lost value as well. Government bonds, for example, the yields moved out on that as the market priced in a chance of there being less buying pressure on those assets as well. So there wasn't really anywhere particular to hide in June, really, because the majority of your asset classes did sell off. We are broadly positioned for that, though, in the Harmoney funds. That has been increasingly our view over the last 3 months or so. So we've been taking equity down, and we've been reducing our sensitivity to the fixed income markets. Duration is, as it's referred to, interest rate sensitivity. So we've been cutting equity, taking profits there, and then on the fixed income side, we've cut our government debt very materially over the last 6 to 12 months. And then within the fixed income portion, moving to credit, and within credit, moving shorter duration, so reducing that interest rate sensitivity, even using floating rate instruments which have very low interest rate sensitivity, and the income is protected on the upside. If yields go up, your floating rate should go up as well. And then on the high yield side, moving down into lower duration, even in the high yield bucket as well. And then finally, I suppose the other position we've been taking to take advantage of that is be higher in cash than we have been of late. And while that's not a great long-term investment for anybody, given the amount of yield you get on cash today, very low, it's a decent store of value when markets sell off.
As you say, James, this has been out there for a while, the flag that the Fed would eventually have to taper, reduce the liquidity they're pumping. We were, to an extent, ready for that. We've been looking out for this. hence it's actually happening. Did that prompt you to make any big changes during the month? You've got this cash. Where's that going to go?
Yeah, we haven't made many changes in the portfolio over June. It really is a case of sitting back, letting this wash over us, if you like, because we are largely positioned for it, at least insofar as our equity had been reduced and our bond duration had been reduced as well. So we haven't been active, particularly in the funds in June, because they were already positioned as we'd want them. Having said that, though, looking forwards, there are opportunities for us to put cash to work now, perhaps greater opportunities than there have been for a while.
Interesting. I've heard managers talking about, say, this is the moment now. This is when we get this big upward rise in yields. Kind of hold on to your hat. Is that what you think? Is that what MGIM think? And in the near term, what are you expecting?
I think the short term remains inherently difficult to predict, and I think the momentum view is very much that while interest rates will go up in short-term government bond markets and the longer-term rates as well, it doesn't have to be an immediate reaction. It doesn't have to be a short, sharp move up in yields. It could be a very gradual sort of death by 1,000 cuts as government bond yields drift up over the next few years. We do, though, take the view that government bond yields will go up, and so on a fundamental valuation-driven basis, government bonds, particularly in the core safe haven markets like the US, UK, Germany, Japan, they look fundamentally expensive today.
We've seen emerging markets underperform developed markets considerably. Liquidity dried up very quickly last month in EMD, EM debt. Are these opportunities you're maybe looking at?
Yeah, as I alluded to earlier, we are looking around the markets very actively at the moment, looking for opportunities. Bouts of volatility do provide opportunities, and so we have to be nimble, and we have processes in place to make sure that we identify opportunities as and when they arise. It's always difficult to move out of your comfort zone, if you like, as markets are falling, but we have a long-term valuation-driven process which sort of, to an extent, forces us to move on the basis that we do so with a high degree of comfort in the long term. Because the valuations are attractive, it gives us a decent degree of confidence that over the long term our positions will be appropriately rewarding for the amount of risk you're taking in the portfolio. So we're looking around at the moment. Emerging market debt, as you suggested, in hard currency particularly, the yields have moved out a lot. Hard currency EMD, generally high quality investment grade government securities now pricing a decent spread over the baseline, which is the US Treasury generally speaking, so that could be attractive. Emerging market equity has been a large underperformer of the developed markets over the last 12 months, and is now at a point where valuations could be attractive against developed markets, so we're looking in there as well. Developed markets are probably about fair value. There are pockets of opportunity though, so you need to go through that next level of analysis, not just looking at developed markets, but maybe think about sectors, for example. There's a number of sectors which are looking pretty attractive today, so we're taking a look at that. And so don't necessarily expect wholesale changes immediately, but it's certainly provided more opportunity today than there was 2 months ago, simply because valuations have come back, and fundamentally I don't think much has really changed to the global economic outlook. I mean, that's the great paradox, of course, with QE tapering. Tapering's only on the table because the economic conditions in the US are improving, which is a positive sign, but you get that short-term anxiety over the lack of liquidity. What does that do for markets? But overall, fundamentally, it's a better economic outcome, which we're expecting.
James, thank you very much.
Thanks, Richard.